everyone, welcome back. So far in this course, we've learned about the misconceptions people have with the markets, and then we moved on towards Raj. Now, Raj was the example of how a small company can become big in 5 years, and he took the decision to go public. Then finally, we moved towards the two exchanges in India, that's the National Stock Exchange and the Bombay Stock Exchange. But we still have a lot of uncharted territory to cover. More specifically, let's go back to Raj, the entrepreneur we left hanging who wanted to list his company on the stock exchange. Now, it's time to execute that plan. So there's 6 basic steps Raj needs to take to list on the Bombay Stock Exchange. The first thing he needs to do is find an investment bank. After this, he'll apply with a registration statement to SEBI. After this, they'll create a fancy document called the Red Herring Prospectus, and then the investment bank will start advertising along with the PR agency. The investment bank will also fix a price band for the value of the shares that Raj is listing at. And finally, the book building process will start and we will get listed on the stock exchange. Now, I'm going to go through each of these processes in detail. Step 1. Finding and appointing an investment bank. Now, without getting into too much details, because the details aren't very relevant in this lesson, Raj needs to find an investment bank. Think about IDBI, State Bank of India, or ICICI Bank. All of these banks have an investment division which take care of these things. Raj picks one, pays a fee, and from then on, the investment bank's job is to take Raj's sweets public. Step 2. Applying to SEBI with a registration statement. Now, we all know SEBI is safeguarding investors all over India. It is independent from brokers, independent from exchanges. It is an autonomous body. If you go to the SEBI's website, its mission statement states that its sole purpose is to provide transparency and save the investor, protect the investor. So once Raj's investment firm, the investment bank, applies to SEBI with its registration statement and gets approval, we're ready to go. Now it's time for the Red Herring Prospectus. Now, as unusual as that name sounds, the Red Herring Prospectus is a fairly simple document. Now, investors want to know about the company. That's what the Red Herring Prospectus does. It contains all the information a prospective investor needs to know. Think about the size of the IPO, company history, financials, and future plans. So if you're an investor who wants to invest in an IPO, the Red Herring Prospectus is where you go first. Now, the good thing about the Red Herring Prospectus is that it covers everything from start to finish. Like in this example, the underwriters that you see involved in this issue are those 3 banks at the bottom. But we'll get to that in just a bit. Step 4. Advertising Raj's Sweets. Now, Raj's Sweets is advertising like crazy. It's on the newspapers, magazine, and even on TV. You see, this improves public perception and helps to create a buzz in the market, which is always good since that's where the demand is coming from. It basically helps in a better listing price on the NSE and BSE when it lists. If you remember, back in 2013, Just Dial was advertising a lot. That's when it IPO'd. Twitter and Facebook went through the same things. Now he's giving interviews and portraying his company as a must-buy. Well played, Raj. Well played. Now, Raj is going to issue a stock split. Stock splits happen very often in the stock market. More often than not, you will hear about big companies offering a stock split. The investment bankers felt, and I'm sure you would too, that the cost per share of 7,165 is a bit much, right? But we can fix this with a bit of financial wizardry. All you need to do is issue a 10:1 stock split. That basically means we know there are 150 shares outstanding, and we also have the per price of 7,165. We multiply the outstanding shares by 10 and divide the price by 10 as well. So now we have more number of shares, but each price is not 7,000, it's 716. Isn't that much cheaper? Much within the grasp of the retail investor. So if you want to invest in one share, it's not thousands of rupees, it's now only 716. But remember one more thing. Raj was reducing this to 20 shares outstanding to the public. Now, that's 200. Now it's time to tackle the biggest behemoth of all, pricing the stock. You see, if you think about the book value of Raj's Sweets, you'll realize that we calculated the per share price of the stock to be 716. Now, this calculation is based on current earnings. But the question is, what about the future? What about the potential that the company holds? Well, that is always priced in. Now, imagine for a second you are a potential investor and want to invest in the company. Now, you find about its future and management and potential by reading through the red herring prospectus. You have a methodology called the discounted cash flow, and by projecting those financials, you calculate the price of the stock is 1,500 rupees a share. Now, that is much higher than what it's offered at right now, at 716. The question comes down to this: would you be willing to pay more than 700? Of course you will. Step 5. The investment bank sets up the price bands. Now, just like you, the investment bank does its homework, but a little more diligently. It goes through all the financials and it knows that it has thousands, sometimes even lakhs of people wanting to invest in the IPO. So, what it does is very peculiar. It makes a price band for people to bid on. In this example, it's 950 to 1000. Now, people like you and I and the public can start bidding on Raj's Sweets within the price band. Apart from the public, we also have other players bidding for Raj's Sweets. Like we have mutual funds on one side, we have institutional investors, insurance companies, and even hedge funds. Now, all these people are bidding between 950 and 1000. This process of bidding between price bands is called price discovery. Depending on the demand and supply, we'll be able to find what is the best price we can place this at. Now, also, there is also something called lot size. When you are bidding for these shares, you can't just bid for one share. There will be a minimum amount. In the case that the minimum amount is 10 shares, then you buy in lot size of 10. So 10 shares, 20 shares, or 30 shares. The bids are now flowing in and Raj's Sweets is oversubscribed. If you remember, 200 shares is what we are releasing to the public, and the amount of bids we have received is 1,000. Clearly, that's much higher than what we're releasing. The investment bank, at this point, seeing the demand, will release the shares at the highest band of this place. That's 1,000 rupees. Also, since this is 5 times more, the excitement in the air will increase, and the investment bank can say the IPO is oversubscribed 5 times. When Facebook went IPO, its price bands were set between $28 and $35 per share. Facebook was looking to raise a little more than $10 billion by issuing more than 300 million shares. It turns out that despite this huge amount the firm was looking to raise, it was oversubscribed 5 times as well. Shares of stocks are traded on a daily basis. So many investors actually falsely assume that when you're buying a stock online, you're buying the shares from the company. That is actually wrong. Let's go back to the Raj example. If you remember, he was releasing 200 shares to the public. That IPO is a one-time event. It happens only once and is called the primary market. The primary market is the IPO, and after the allotment has taken place, it lists on the stock exchange, like the National Stock Exchange or the Bombay Stock Exchange. Then is when trading happens between people, between traders, and that is the movement you hear of every day. This is called the secondary market. So just remember, when you hear about a stock moving up or down on a daily basis, that is between people. The demand and supply of people gives us an idea of whether the stock is going up or down. But you see, one question still remains. How do we know if a stock is overpriced or underpriced? Let's see what you can use to find out when you can buy a stock. One of the basic ways to know how a stock gets priced is through the PE ratio, or the price to earnings ratio. Now, this ratio is basically calculated by getting the share price of the current stock and then dividing it by the EPS, or the earnings per share. Now, this ratio is very interesting. It gives you a multiple of how much investors are willing to pay per share of the stock. Let's go back to Raj in lesson 2 that we discussed. His company's book value was 716 rupees per share. Now, think about it. If you are a prospective investor and you read through his red herring prospectus and found out that his company is expanding over the next few years to multiple cities, let's say 1,000 new stores in the next 5 years, wouldn't you be willing to pay slightly more? Let's say your calculation found out that the stock could be worth 1,500 rupees per share. It's valued at 716 now. Wouldn't you be willing to pay slightly more? Well, that is the exact reasoning of forward earnings. A high PE ratio means investors expect a high earnings growth. On the flip side, you can also have a low PE or even a negative PE. Now, a 0.5 PE basically means investors expect a negative growth in the company and is being priced very, very low. That being said, there's no set rule of what the perfect PE ratio should be. It's different for every industry, and that's where lies the key. That's a good indication and of how you can know what stock should be priced at what PE. Let's look at Raj's Sweets again. So we look at the peer of that area, that is the sweets area, and we'll find that the industry-wide PE ratio is say 10, and Raj's Sweets is valued at 3. That's a good indication that Raj's Sweets is underpriced. How do you know whether you can purchase a stock with a PE of 2000 or a PE of 0.2? Well, as I said before, PEs can be absurd. And this is exactly why you need a trading methodology. At Trade Academy, we'll cover both styles. That's fundamental analysis, which uses financial information such as PE ratios to value a stock. And then you have technical analysis, which uses market-wide psychology through price charts to find your entry and exit points. Now, both can be used for trading and investing. In the next lesson, we're going to equip you with the basics. So what website should you go to for financial information, and how do you pick a broker? Not only that, we end the lesson by going through the methodologies of the top 5 best investors and traders. So now you'll have an idea of what the best do and choose for yourself. You know what? Your journey has only just begun. I'll see you in the next lesson.